Imagine earning the exact same salary as someone else this year. You both save $70,000 sitting quietly in the bank. Then, one weekend, your paths split in a huge way. You sign mortgage papers, or you renew your apartment lease again. Everyone says buying is smarter and renting wastes your money. But that popular belief ignores thousands of dollars in hidden costs. It ignores years where your payment barely touches the loan balance. It ignores what happens if you invest every dollar you save. Nobody tells you exactly when buying finally beats renting financially. This breakdown shows the real math behind that exact decision. Millions of people face this decision without understanding the real math. Today's video breaks down the true cost of renting versus buying. You'll learn the exact framework for comparing both paths honestly. This isn't about which choice sounds smarter or feels safer. It's about tracking every dollar across years, not just one payment. We'll compare a typical buyer and a typical renter side by side. Both start with identical income, identical savings, and identical housing options. One chooses a mortgage, the other chooses to rent and invest. This comparison will show exactly where each strategy gains or loses. Let's start with the moment these two paths first begin diverging. Picture two people, both 32, both earning $80,000 yearly. Both have saved $70,000 after years of steady discipline. Both are looking at homes in the exact same neighborhood. A typical three-bedroom house in that neighborhood sells for around $350,000. Renting a similar home nearby costs about $2,000 every month. One person decides to buy, using savings as a down payment. The other renews their lease and keeps their savings invested instead. Their monthly loan payment, without extra costs, comes to $1,900. The renter invests the entire $70,000 into a market index fund. From here, their financial paths begin to look very different. Most people simply assume that buying always builds more long-term wealth. The homeowner is seen as building equity with every payment. The renter is often told they're simply throwing money away. This belief feels obvious, so almost nobody questions it closely. But the full comparison rarely includes every real cost involved. Appreciation often gets celebrated, while closing costs get quietly ignored. Maintenance, taxes, and insurance rarely appear in these simple comparisons. Flexibility and freedom get praised, but the investing side gets skipped. Almost nobody asks what happens if rent savings get invested consistently. That missing question changes this entire debate more than anything else. The real comparison requires tracking every dollar, not just the mortgage. Buying carries costs that arrive before the new owner even moves in. Renting carries a savings advantage that only counts if it's invested. Neither path is automatically better without looking at actual numbers. The outcome depends far less on the house than on habits. Financial habits after the decision matter more than the decision itself. This video walks through the complete math step by step. No sales pitch, no bias toward buying or renting either way. By the end, you'll know exactly when each option wins. Let's start by looking at what buying actually costs up front. The moment papers are signed, the buyer isn't financially ahead yet. Closing costs quietly add thousands of dollars beyond the down payment. Loan fees, title insurance, and legal paperwork all add up fast. Escrow expenses and moving costs pile onto the total even more. A $70,000 down payment can easily become an $80,000 investment. That hidden gap creates a hurdle before buying even starts working. The house must first grow enough to cover those upfront costs. Most rent versus buy comparisons online completely skip this early financial hole. It's one of the biggest blind spots in the entire debate. Understanding this hurdle changes how the rest of the math works. Many new buyers believe every payment builds meaningful equity right away. In early mortgage years, that assumption isn't actually how it works. On a 30-year loan, most of each payment covers interest first. Only a small fraction of the early payment reduces the loan balance. In simple terms, the lender gets paid before the owner does. Equity in the first few years grows far slower than expected. Add property taxes, insurance, and upkeep, and costs climb even higher. Total monthly housing costs can rise well above the loan payment alone. Yet only a small piece of that total builds real ownership. Many buyers don't realize this until months of payments have passed. Meanwhile, a renter's monthly payment disappears completely, with no equity gained. That fact alone makes renting sound like the obviously worse choice. But a homeowner's extra costs also disappear without building equity either. Interest, taxes, insurance, and repairs simply pay for staying in the home. The phrase, renting wastes money, oversimplifies a much more complex picture. Both paths involve money that never comes back to either person. The real question is which option leaves more total wealth later. That answer depends on tracking numbers across years, not one payment. Comparing only the mortgage to rent misses most of the story. Next, let's see how these numbers actually compare after a few years. The renter's strategy depends entirely on consistently investing the savings gap. Instead of a down payment, that money goes into an index fund. Each month, the difference between rent and the total housing cost gets invested. That gap might only be a few $100s every month. Small and consistent contributions matter more than any single large deposit. This strategy only works if the investing habit stays completely consistent. Skipping months or spending the difference erases the entire advantage. The renter also avoids every repair bill during this early period. No water heaters, no roof issues, no unexpected maintenance expenses appear. That freedom lets savings grow without any surprise financial interruptions. After 3 years, the homeowner's loan balance has dropped somewhat noticeably. Rising home values have added even more to that ownership stake. On paper, this looks like real and meaningful financial progress. Meanwhile, the renter's investment account has been compounding the entire time. Regular monthly contributions have steadily built a growing pool of assets. Neither side has pulled dramatically ahead after just 3 short years. The homeowner has built equity tied directly to one single property. The renter has built a diversified stake across many different businesses. Both represent real wealth, just structured in very different forms. The bigger differences only start showing up much further down the road. Home equity isn't something you can access with a simple tap. Reaching that money usually requires selling the house or borrowing against it. Both options come with additional costs and considerable amounts of time. Investment accounts, by comparison, can often be accessed within a few days. That difference matters enormously during emergencies or unexpected financial opportunities. Liquid wealth offers flexibility that property wealth simply cannot provide. But property ownership offers stability that a rented apartment cannot offer. Each path trades one advantage for a very different kind of advantage. Understanding this trade-off matters more than picking an obvious winner. The next major shift appears once maintenance costs start piling up. Owning a home resembles owning a car more than most people realize. The purchase price is only where the real costs actually begin. Water heaters fail, roofs get damaged, and air conditioners eventually break. These repairs rarely arrive one at a time in a predictable order. Some years bring almost no repairs, while other years bring several. Financial planners recommend saving monthly for maintenance before anything even breaks. That saving isn't optional. It's preparing for bills that haven't arrived. Renters avoid these repair bills, since landlords cover those expenses instead. Those costs don't vanish, though. They often get built into rent. That connection rarely gets mentioned in typical online rent versus buy debates. Property taxes tend to rise as home values continue climbing higher. Insurance premiums can increase steadily over years of home ownership as well. Utility costs may grow too, especially in a larger owned home. Little by little, true ownership costs exceed the original mortgage payment. None of this makes buying a bad financial decision on its own. It simply means honest comparisons must include every single ongoing expense. The biggest buying cost isn't always the money actually spent directly. Sometimes it's the money that never gets the chance to grow elsewhere. That missed opportunity quietly reshapes the entire wealth comparison over time. Understanding opportunity cost changes how the next decade plays out. Renters face rising costs too, since lease renewals rarely stay flat. A monthly rent that started low can climb significantly within years. Every increase shrinks the amount available to invest each following month. What once felt like a huge monthly savings gradually becomes much smaller. Meanwhile, a fixed-rate mortgage payment stays largely predictable across those same years. Taxes and insurance still shift, but the core loan payment doesn't change. Time tends to push rising costs onto renters more than owners. Time also tends to shift more equity toward owners with each payment. That shift becomes one of the biggest factors after 10 full years. Let's look closer at what actually happens across that longer time frame. After 10 years, the homeowner's loan balance has dropped quite significantly. Home appreciation has continued adding real value on top of that. More of each payment now goes toward principal instead of interest. The renter's investments have also kept compounding through market ups and downs. Staying invested through downturns matters more than trying to time markets. By year 10, that portfolio may rival the homeowner's total equity. But rent has climbed steadily, shrinking the renter's monthly investing room. The mortgage payment, meanwhile, has remained largely fixed and predictable. Both strategies benefit from time, just through very different mechanisms. The next decade tends to make this gap even more noticeable. After 20 years, home equity often reaches hundreds of thousands of dollars. The renter's portfolio may still be comparable, depending on market returns. At first glance, that looks like a clear win for renting, but rent has kept rising the entire time without ever pausing. Each increase has steadily reduced how much the renter could invest. The homeowner's core payment has stayed fixed since the very beginning. Inflation has quietly worked in the homeowner's favor over those decades. Income typically rises, while that fixed payment stays exactly the same. Within another decade, the mortgage disappears completely for the homeowner. That single change dramatically shifts the entire financial picture forward. Renting only builds wealth if the saved difference gets invested consistently. Skipping contributions during market crashes erases much of that advantage. Spending the difference on upgrades quietly cancels out the entire strategy. A mortgage, by contrast, forces monthly discipline without requiring a decision. That built-in structure has helped many ordinary families build real wealth. Homes don't always outperform investments, but mortgages enforce consistent saving habits. Behavior consistently matters more than which strategy looks better on paper. A disciplined renter can outperform an undisciplined and inconsistent homeowner easily. A disciplined homeowner can also build enormous long-term equity over time. In both cases, consistency decides the outcome far more than luck. Let's recap what this entire comparison actually revealed about renting and buying. Buying comes with hidden closing costs that arrive before any equity. Early mortgage payments mostly cover interest, not the loan balance itself. Renting only wins if every saved dollar gets invested every month. Maintenance, taxes, and insurance quietly raise the true cost of owning. Rising rent slowly shrinks a renter's ability to keep investing consistently. A fixed mortgage becomes more valuable as years and inflation pass. Liquid investments offer flexibility that trapped home equity simply cannot match. Neither path guarantees wealth without consistent financial habits behind it. The real difference always comes down to numbers, not assumptions. Start by asking how long you plan to stay in one place. Staying 7 to 10 years usually makes buying much more attractive. Uncertain plans or frequent moves usually make renting the safer choice. Ask yourself honestly if you'd actually invest the difference every month. If the honest answer is no, renting loses its biggest advantage. Ask if you're financially ready for unexpected repairs and rising costs. Buying means committing to decades of ongoing financial responsibility and upkeep. Neither renting nor buying is automatically the smarter financial decision. The right choice depends entirely on your habits, timeline, and honesty. Use these questions before comparing a single mortgage or rent quote. Your financial future won't be decided by simply choosing rent or buying. It will be decided by what you consistently do after that choice. A disciplined renter can absolutely become just as financially independent as anyone. A disciplined homeowner can absolutely build enormous long-term equity as well. Success in either path comes down to habits repeated for years. Spreadsheets and calculators only tell part of this entire financial story. People, their habits, and their consistency tell the much bigger story. Start today by tracking your own numbers instead of relying on assumptions. Compare your real costs honestly before locking into either long-term path. When habits outlast emotions, almost any reasonable strategy can build wealth.